Good Tuesday morning, Market Chameleons, and everyone joining the Market Chameleon pre-market show for the first time. Welcome. And here he is, coming in all the way from beautiful Philadelphia, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help answer your questions, give you guidance, give you advice. So there's a disclaimer.
There it is.
We'll get started. I'm going to share my screen. While I'm doing that, if you guys have any questions, please put those questions on a live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on a show, ask your question live. We also provide a link to Zoom. When you go to Zoom, click on that link. It takes you over to Zoom. Once you get to Zoom, there's a button, raise your hand. Click on that. It will prompt you to turn on your video camera. You don't have to turn on your video, but once we let you in, everybody will be able to hear you. You could ask your question then directly. While we're waiting for questions to come up, what I'll do is we'll do the pre-market report, see what's trading at pre-market hours. I had a couple questions come in that were unrelated. So one was the VXX ETF, looking at the implied volatility. There's a couple other ones kind of related to implied volatility, but maybe what I'll do is take that question regarding VXX. So VXX, it's an ETF, tracks the VIX index. Okay, so maybe we'll take a look at that. But if questions come in, Will let me know. I'll take the questions.
Sounds good.
All right, so pre-market report. These are stocks trading in pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 233 stocks made our percentage gainers list, 45 on the decliners. So from this perspective, we're looking like we're lining up for a more bullish bias at the open. I'm going to filter this list to only S&P 500 companies. We'll take out ETFs, closed-end funds, preferreds, small cap stocks, rights, units. Take all those out, only to focus on what's going on in the S&P 500. I'm going to use this filter here. These filters control the report below. The filter in ETF, I'm going to drop it down. If you select one of the ETFs from this list, it will filter out the holdings in that ETF. SPY, that's the S&P 500 ETF. Let's select that. And when we do that, the list below got filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. And here we see 52 stocks made our percentage gainers list, 4 in the decliners. Again, that from this perspective, we look like we're setting up for a more bullish bias at the open. Couple things tomorrow. The Fed will be the Fed interest rate decision. Everybody expecting 3 quarters. Now, Wall Street is anticipating that going further, they're going to slow down the interest rate hikes and maybe give us an indication of what the terminal rate will be. And I think we're looking, in the 4s before. Some of the banks are now forecasting that that rate will peak at 5%. But I think ahead of that news, markets rallying. Maybe a couple earnings have been okay so far. They've been pretty good in some places. It's not like very terrible. And China, some news out of China that they're gonna loosen up some of these restrictions with COVID. And then we're getting this rally. We're talking about yesterday, seasonality, November, historically a strong month for the market, tends to do well in the month of November. We'll see how it plays out this year. But those are the things to watch out for. If we don't have any questions, Will, maybe what I'll do is move on to the VXX.
Perfect.
All right. And the question that I got, this morning, I was reading the emails. The question was, well, what VXX implied volatility 51.4? Why is that in a 0 percentile rank? That has to be wrong. That was the question. And let's first discuss what is VXX. And I do want to, one thing, as we're going through this and just analyzing it, the thing that distinguishes, like, say, a professional trader from somebody who's amateur and just logging into like their retail account starting to trade is that professional traders are very detail oriented. They don't just make assumptions and go with it. They go in there and really figure things out and read about it. They're not lazy. They'll create models, usually pricing models. They don't think of in terms of, is this going to go up and down, as much as, well, what do I think this thing is even worth? How do I price it in the beginning? What is it sensitive to? What is the price even sensitive to? What makes the price go up? What makes the price go down? Is it earnings? Is it volatility? Is it interest rates? Is it sales? But very detail oriented. The best traders. We've been around some of the best traders because we traded on the floor of the exchanges. We're members of American Stock Exchange, Philadelphia, CBOE. And that's what you often see, that people are very detail oriented. I'll give you an example. Just the first people, when the ETFs came out, the ones who did the best, the most successful, were those that just took the perspective, figured out, well, how do I price these ETFs? What are they worth? How do I redeem them? How do I create them? How do I price them? And the people who took time to do that did really well. We're talking about, hundreds of millions, billions of dollars in operations. And some of them started from nothing. We saw that ourselves being on the stock exchange. And when people assume, it's really, it's probably the worst thing you could do without verifying and validating, because the easy way, the lazy way, is just to assume something works in a certain way and not figuring it out. And that also happened with the leverage products. When those leverage products came out, the double long, triple long, double short, people assumed it worked one way, and if they invested it in it, like long term, they would get double the returns of the S&P 500 or double, and they didn't work that way because they reset every day and all this stuff. And the people who just took the time to learn what they are, figure out how to price them, made fortunes, and that's an important thing, not to be lazy. You got to read and figure things out. So the VIX, so right now, SPY, let's take a look at that. What was the question? SPY implied volatility is 24.4, 65, 65th percentile rank. Obviously, the implied volatility is not at a yearly low, right? That implied volatility is still. Let's take a look at the chart. And I don't get to ask the questions, but this is where I think that Hugh's looking at that. Well, here's the implied volatility. We're obviously not, you know, it was much lower here. So this is the implied volatility of SPY. But why is then the VIX, VXX? You could see VXX is at a 52-week low, basically. Right, VXX is very low. And what about the implied volatility of the VXX? Let's take a look at that. Here's the implied volatility of VXX. We could see here, you know, once they started raising interest rates, really spiked up here. A lot of volume. It's been trending kind of lower, lower, lower. Now we're at a 52-week low as well with the VXX. And let me come over here. And what is the implied volatility? The implied volatility, it's coming from option prices, right? Which is a forecast of the future volatility of the underlying, right? That's where the implied vol is. Why would it be low though in the VXX? And the first thing is, it's what the VXX represents, right? How does VXX even get priced? Because this is an ETF, right? VXX is an ETF, and what the ETF does is invest in futures that roll, right? So it's a rolling future because futures expire, right? You go in there, you buy a future, but eventually it reaches expiration. So at some point you got to sell that future and go back out and buy a new future. So it's rolling this future, and the future is the VIX index. Okay, so it's based on the VIX index, which has its own calculation, and I can't explain it all right now, but basically the VIX index is trying to track a 30-day constant maturity implied volatility, and it has this whole methodology and it has this whole formula, and it looks at the implied volatility, you know, across all the strikes, and then it has these weightings, and it depends on lots of factors in there. So it's a methodology. It's not just like it's not even a number you could plug in. It has logic to it. So, you know, it treats options that have no bid one way, it's a penny another way. You know, what if the options are inverted? All this stuff, it has a methodology to it. And it does, and what it's trying to do is just capture what the implied volatility, how the implied volatility is moving. Is it moving up or down? And volatility, right? The implied volatility, this implied volatility in the options is basically a forecast of the vol of the vol, right? Because the VIX is the volatility, and the implied volatility of the VIX is how much of the vol is going to move around. So if implied volatility is very high, but it remains constant, right? Let's say implied volatility is very high in the SPY, like at 50. And if the stock moves around a lot and the implied volatility stays at 50, pegged at 50 the entire time, so the vol of the vol is zero, right? Because it didn't move. That means that even though SPY is volatile and the implied volatility in SPY is high, the VIX, the implied volatility of the VIX is saying how much will the implied volatility move around, okay? Not how much SPY will necessarily move around, how much the implied volatility will move around from day to day. Does that make sense to people? That's what the options are on the VIX. There are a couple things about how the VIX is calculated that make it move around even more or less. And one of them is the skew, So let's just take a look here. I'm going to go to try to find an option. Let's go out to November 30th. So a month out. And the skew plays a big part as well. And what do I mean by that? You see here, the implied volatility for each strike is different, right? And what does this mean? That, well, if the stock goes up, down, the implied volatility, right, is expected to change, going up a little bit. And if it's going up, the implied volatility is expected to come in a little bit. When you have a flat skew, let's say that this skews, the more flat it is, the less the VIX is going to move around. In other words, if all these were flat, going all the way down, right now you could see it, they're becoming more flat. We'll take a look based on historicals, but they're getting more flat than usual. And what this is saying is that the stock could go down and the implied volatility would remain the same, and the stock could go up, implied volatility could remain the same. That's a flat skew. A flat skew means it doesn't matter where the stock will end up, the implied volatility will always remain the same, right? So let's say the stock went up 10%, but if the VIX, if this was 24 and then you're up here, it's 24 all the way across, volatility didn't even change. So you could see why, as the market is moving, the VIX is moving too, because here you could see there's a skew. So as it's moving, implied vols are changing. But as we get a flatter curve, if it's flattening out, the VIX is expected to move less than it did before. So let's take a look at that. This is an SPY. Here is the, let me see if I have, here, let's do, so this is a 30-day, okay? Here's a 30-day implied volatility skew based on the delta. So you start at the money, and as you go up, this is how the skew looks. As you go down, this is how the skew looks. So here's the current one. The current one, oops, hold on, how do I get out of that? Let me refresh the screen and press something that. So this current one is in the middle. So the 52-week average, that's this long one going down. See this really one that slopes a lot? That's the 52-week average. And if you look at the one above, it slopes, even though it's higher, the implied volatility is higher. Look at the slope. You see how it's flattening out? It doesn't drop off significantly on the way down, right? So if you start at the 50, right at the money, do you see the 52-week average, how fast it sloped up on the way down and how fast it sloped down on the way down? Well, this one, even though remember, it doesn't matter the starting points, how much you expect it to move. That's the implied volatility of the VIX. Its slope, right, going in each direction, its slope came in, right? It's not moving, spiking up as significantly, or spiking or getting pushed down as significantly as that 52-week average. So that's one thing that's coming into play, that the implied volatility skew, as volatility goes up, is starting to flatten out. Okay, do people see that? Do you kind of understand that? Because remember, it's the volatility of the vol. That's what we're looking at. How much will the VIX itself move around, right? So that's what we're looking at, and that part is starting to flatten out. Another factor is we'll call this the vertical skew, right? This is the vertical skew. This is the skew that's going through the strikes, going up and down. The There's also a roll. Remember, we talked about a roll, that the VIX itself is not a stock. There's no, as SPY, it's a stock, right? You could buy and convert it to, the holdings, so it's like a basket of stocks, let's say, right? The ETF. Well, the VIX, there's nothing to convert it to. It's just a calculation. What's a VIX? A VIX is this. A VIX is looking at the options, right? The option prices, converting it to an implied volatility. And that's what it's tracking. It's tracking a number, right? Like, you can't buy the VIX, right? You can't take over the VIX and say, I'm buying all the shares in VIX and now I have a business. It's not like that, right? There's no business, there are no workers and earnings, nothing like that. It's just tracking a number. That's what it's doing. It's tracking a number, right? You can't convert it to anything. And that number is represented, is being tracked by a future. It's basically a settlement. Where will this number be in the future? And it's a roll, right? So you have to roll that future. You buy it, like, whatever it is, 30 days out, 60 days out. Then as it gets closer to expiration, you got to sell it, and then you got to go out and buy it again. That's what you're doing. But when you're doing that, you're rolling a future, then the term structure comes into play. And what I mean by the term structure is the following. And it'll be a formula. They have maybe two futures. I don't know, like two futures that straddle 30 days. And as the futures are getting closer, they'll sell, one future to go buy the next future out. So that it's trying to keep that roll going. You could go and read about it. Go read about it, how they do it. But it is basically a rolling the future. And what will happen is, when you buy a future, let me show you compared to 6 months ago. So this is 6 months ago, right? You could see what happened was that the near-term month got inverted versus the longer term. And when this happens, it's basically signaling that the market's going to move around. That's when you have those gamma moves. Basically, the very near term, very high demand for those options, meaning people are buying gamma, looking at bigger stock movements. That's what happened 6 months ago, but it did slope, right? There was a bigger slope. Here we are over here, and you could see it's flatter. The now is the one below, meaning that the roll doesn't cost you. By the way, here you're actually making on the roll, because if that term structure remained like this one 6 months ago, right? If you're buying a future, let's say at an implied volatility, what was this? I'm looking 27, and as that future got closer to expiration, the implied volatility was 28. You're actually then making money on that roll, right? All else being equal, you're making money on the roll, because as it's coming closer, the implied volatility is going up. Usually, though, it's the inverse. Usually you're renting volatility and you're paying to hold it. But this was a special case because the market obviously was anticipating, bigger movements. So that's what it was 6 months ago. Here we see it's flatter now, right? And when it's flatter, that implied volatility of the VIX is going down. So it's not expected to move as much from the roll from one to the next. Okay. Does that make sense to people? So you have a couple things going. The skew comes into play just as much as the implied volatility moving around. So coming back, we only have a couple minutes I don't hear any questions. So why is the VIX, the VIX, the implied volatility on the VIX coming down? Yeah, there are other factors. This is not the implied volatility on the VIX is not saying will the implied volatility of SPY stay high or low. It's how much the implied volatility is expected to move around. And relative to the previous year, now it's expected to move around less, right? Hopefully that makes sense with it.
That was helpful, D. We don't have any questions at this point. Thanks so much, buddy.
All right. Well, everyone, thanks for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Great, D. Thanks. Have a great trading day, everyone. Bye.